Hello, welcome to my channel. This is Eunice Financial Academy. In today's video, we are going to continue with journal entries. Remember, in our last video, we said a journal is the first book where any transaction in a company is recorded. And then we went further to look at the debit and the credit entry. We said a debit is an entry made on the left-hand side and a credit is an entry made on the right-hand side of a journal. And then we said that debit increases the asset and the expense account and credit increases the liability, equity, and the revenue account. So when doing our journal entry, we need to take the golden rules of accounting into consideration. The first golden rule says debit all losses and expenses, credit all gains and income. The second one says debit the receiver and credit the giver. The third rule says debit what comes in and credit what goes out. So there are some techniques that you take into consideration when doing your journal entry. The first technique say identify the two accounts or the accounts that are affected by the transaction. And then you also identify the account that is increasing and the one that is decreasing. The account that is increasing, you debit, and the one that is decreasing, you credit. And also make sure that the accounting equation stays in balance, meaning the debit side must always be equal to the credit side. So those are some of the rules or factors that you need to consider when doing your journal entries. So let's dive into the question. The question says 1st January 2021, Eunice Venture started business. And then the first transaction, purchase good for $6,000 with trade discount of 10%. So the first thing we need to do is to identify the accounts that are in this transaction. So if we purchase goods, it means that the first account is the purchase account. And then we purchase for 6,000 and we receive a trade discount of 10%. So we purchase with cash. So that is the second account. So we purchase the good for $6,000 and then we receive a discount of 10%, meaning that we need to calculate 10% from this amount. 10% of 6,000, which is 600. So if we subtract 600 from 6,000, we have $5,400. So this is the account that, or the figure that we are going to be looking at. So the two account, purchase account and the cash account. The purchase account is receiving. So it is receiving, so we debit, and the cash account is giving, so we credit. So let's look at the solution. So we debit the purchase account because we have purchased good and purchases is coming in, and we credit the cash account because cash is going out of the business. So we receive a trade discount of 10%. We calculated it on the 6,000 and we finally paid 5,400 to the supplier. So that was cash purchase and discount. So let's move to the second transaction. The second transaction says sold good to John $500 and catch sales of $800. So if we sold goods to John, it means that we sold on credit and we also made some catch sales. So, but the whole thing is that we sold good for $1,300. So if we sold good for $1,300, it means that cash is increasing. The cash account is increasing, or cash is entering the business. So the first account we have here is the cash account. Cash is entering the business. And then the second account that we have is the receivable account. The receivable account is also increasing, and the last one is the sales account. So the sales account is reducing. So we debit the cash account, we debit the receivable account, and we credit the sales account. So let's look at the transaction. So we debit. So account receivable 500, the money that we sold to John, and cash 800, and sales 1,300. That was credit and cash sales that we made. So let's look at the next transaction, which says distributed goods worth $900 as free samples and $100 good to owner. So looking at this transaction, it shows that some of the goods were being given out for free, maybe for marketing purposes, and it worth $900, and goods worth $100 were given to the owner. So which accounts are affected in this transaction? So we have the free sample account, the free sample account. We have drawings. When you give goods to the owner, or when the owner withdraws or takes goods or cash from the business, in accounting we call it drawings. So we have drawings, and then all of this drawing and free sample, it is already an expense to the company, because no cash is coming out after performing all these transactions. No cash is coming in to the business. So it is an expense to the business. It means that cash worth 1,000 is going out of the business. So we credit the cash account. So we debit the free sample account, we debit the drawing account, and we credit the cash account. So this is the solution. The free sample account, we debit it with $900. The drawing account, we debit it with $100 and credit the cash account with $1,000. The narrative is distribution and drawings. So let's move to the next question. The next question says, on the 12th, receive discount $50 and commission $30. So when we receive discount, and commission, or when the business receives discounts and commission, it means that cash is entering the business. So if cash is entering the business, it means that the cash account is increasing. So the first account that we have or that is being affected by this transaction is the cash account. We have the cash account, and the next account is the discount account, and the commission account. So the discount account is given to the cash account, and the commission account is also given to the cash account. So if we sum these two amounts, then we'll arrive at the total cash that entered the business. So this is the solution. We receive a total cash of $80, and then we credit the discount account $50 and the commission account $30. So the narrative is discount and commission received. So that is the narrative. So let's move to the next question. The next question says, on the 24th, furniture lost by fire, $5,000. So we need to identify the two accounts in this transaction. The first account is the loss account. Loss account. Remember the first golden rule that says that you debit all the expenses and the loss. So here we are incurring a loss. The business is incurring a loss. So we debit the loss account. So we have lost furniture, and that furniture worth $5,000. So we have to credit the cash account. Because cash is being lost as a result of the outbreak of fire. So those are the two accounts that are being affected by the transaction. So we debit the loss with 5,000 and we credit cash $5,000. So the narrative is furniture lost by fire. So that is it for that transaction. So let's look at the next transaction. They said on the 30th, bad debt during the period was $10,000. So bad debt during the period was $10,000. So what is bad debt? It means that the company gets some goods to the customer, and maybe they have tried to recover the money from the customer because they gave the goods on credit, but to no avail. So now it have come to a point where the company have already recorded as a bad debt because they have seen that they cannot collect the money from the customer again. So now it is already an expense to the company. Bad debt is an expense to the company. So the first account in this transaction is the bad debt account. So remember when the customer took the goods on credit, so it was being recorded in the account receivable ledgers as maybe receivables. So it was recorded in the account receivable ledgers as a debit balance or a debit entry. So now that the customer have not paid the money and it has been recorded as or declared as a bad debt, now we need to credit the account receivables, meaning balancing the debit and credit equation, which says the debit must be equal to the credit. At first, the amount was debited in the account receivable ledger. So now we need to credit it. So now we credit the account receivable or receivables. Those are debtors, receivable account. So those are the two accounts that are affected by this transaction: the bad debt account and the receivable account. So this account, the bad debt account, is debited with, yeah, this is the transaction. We have the bad debt account 10,000 and the account receivable 10,000. Bad debt recorded. So that is a narrative of the transaction. So at the end of the transaction, remember you sum all the debit and the credit column. So if you sum everything, the debit column must be equal to the credit column. So the debit column must be equal to the credit column. So if you sum everything, you will arrive at this amount. So thank you for watching and see you in our next video. So please don't forget to like, share and subscribe. Thank you for watching.